What if I told you there's a group of investors getting paid $4,520 every single year for doing absolutely nothing? Not trading, not timing, not even watching the market, just collecting checks while everyone else panics about the next crash. Here's what's insane while most people chase the next hot stock. There's a $71 billion ETF quietly printing money for retirement savers month after month. And the craziest part? The more the market crashes, the better their future returns get. Quick note, I'm sharing educational content about dividend investing strategies, not personal advice. All investments carry risk, including potential loss of principal. Do your own research and consider consulting a financial advisor. Today, I'm revealing 4 specific dividend growth ETFs that could potentially transform your investment portfolio, including one that's grown its payout 13 years straight, and another paying monthly passive income that most people have never heard of. Let me tell you about Harry. 3 years ago, Harry was like most investors, checking his portfolio daily, stressed about every dip, trying to time the perfect entry. Then he discovered something that changed everything. See, while everyone obsesses over stock prices going up, they're missing the real wealth-building strategy: dividends. Think about it. When you buy Amazon, you're betting someone will pay more later. But when you buy a dividend growth stock, you get paid to wait every single quarter. Since 1926, dividends have contributed 32% of the S&P 500's total return. During flat decades, dividends contributed 90% of returns. That's not investing. That's getting paid to own assets. And here's what nobody tells you: those dividend payments are real cash hitting your account. Not paper gains, not theoretical returns. Actual money you can spend, reinvest, or use to build financial independence. But here's where it gets interesting. Most people buy individual dividend stocks and pray they don't cut their payments. Remember GE? Cut their dividend 92% in 2018. AT&T? Slashed by 46% in 2022. That's why smart money doesn't buy individual dividend stocks anymore. They buy baskets of them. Enter the first weapon in your passive income streams: Arsenal, DGRO, the iShares Core Dividend Growth ETF. This isn't your grandfather's dividend fund. DGRO holds 405 companies that have consistently grown their dividends. Current yield? 2.05%. Sounds small? Here's what they don't tell you. This fund doesn't chase the flashy 8% yields that disappear overnight. It targets companies with proven track records of raising payments year after year. DGRO doesn't chase the highest yields. It chases dividend growth. Companies like Apple, only 0.4% yield, but growing payouts 5% annually. Microsoft, 0.7% yield, but compound interest working over time. Visa, barely 0.7%, but increasing dividends 15% plus every year. The result? 94.40% total return over 5 years. That's not just dividends, that's dividends plus appreciation. And with an expense ratio of just 0.08%, you keep almost everything. Harry realized something crucial here. A 2% yield growing at 10% annually beats a 5% yield that never grows. In 10 years, that 2% becomes 5.2%. In 20 years, over 13%. Asset allocation matters, but growth trajectory matters more. Because here's the math most people miss: a stagnant 5% yield stays 5% forever. But a growing 2% yield becomes your best performer in year 15. This is the secret wealth-building strategy. The ultra-rich understand. But DGRO is just the appetizer. Wait until you see what's been quietly dominating for over a decade. Now let me blow your mind. What if you could get paid every single month instead of quarterly? Enter DIVO, the ETF nobody talks about. 4.52% yield paid monthly. That's $452 per year on every $10,000 invested. Harry put $100,000 into DIVO. His monthly check? $376. Every single month, like clockwork. Here's the twist. DIVO doesn't just collect dividends. They write covered calls on their holdings, extra income on top of dividends. It's like getting paid twice on the same investment strategy. Top holdings, Apple, Microsoft, JP Morgan. Blue chips generating monthly cash flow. For Harry, this changed his financial planning. Instead of waiting 90 days for quarterly payments, he gets monthly deposits, pays his mortgage, covers utilities, reinvests the rest. Monthly income isn't just convenient, it's psychological freedom. Think about it: 12 payments per year versus 4. That's 12 reminders that your money is working for you. 12 opportunities to reinvest at different market prices. 12 dopamine hits that keep you invested during volatile periods. But here's the crown jewel. SCHD the Schwab. US Dividend Equity ETF. 3.80% yield. 0.06% expense ratio, basically free. 13 consecutive years of dividend growth. Even through 2008. Through COVID. Through everything. $71 billion under management. You know what that tells me? Smart money parks here. Harry discovered SCHD holds companies like AbbVie, Chevron, Coca-Cola. Boring? Maybe. Profitable? Absolutely. 10.38% annual dividend growth over 5 years. Your income literally grows faster than inflation. This is where financial independence gets real. Let's say Harry invested $50,000 in SCHD 5 years ago. Year 1 dividend, $1,900. Year 5 dividend, $3,100. Without adding a single dollar. That's the power of dividend growth compounding. The yield on his original cost keeps climbing while the market price adjusts. Here's what that means in practice. While SCHD shows a 3.80% yield today, Harry's personal yield on his original investment is now 6.2%, because he bought years ago and the company kept raising payments. This is yield on cost, the metric that separates wealthy investors from everyone else. Now, for the Granddaddy SDY. This fund only holds dividend aristocrats. Companies that have raised dividends 25+ consecutive years. We're talking Johnson & Johnson's 61 years of raises. PepsiCo 51 years straight. Procter & Gamble's 68 consecutive years. 2.62% yield might seem modest, but these companies survived every crisis since the 1960s and kept paying investors through all of it. The Cuban Missile Crisis, oil shocks, Black Monday, dot-com bubble, 2008 financial crisis. COVID, still paying, still growing. 75% total return over 5 years proves one thing. Consistency beats excitement in long-term investment research. Harry uses SDY as his sleep well at night holding, the anchor that steadies his portfolio when everything else shakes. Because when you own companies that paid through 60+ years of chaos, you stop worrying about next quarter. These aren't speculative tech startups burning cash hoping for profitability someday. These are established businesses with decades of proven money management and shareholder returns. Here's what happens when you combine all four. Harry split $100,000 equally. $25,000 in DGRO, growth focus. $25,000 in DIVO, monthly income. $25,000 in SCHD, balanced approach. $25,000 in SDY, aristocrat stability. Annual income. Year 1, $3,247. Not life-changing yet. But Harry reinvests every dividend through tax-advantaged accounts. Year 5, his annual income hits $4,820. Year 10, over $7,200 annually. Year 15, approaching $11,000, without adding a single dollar beyond the initial $100,000. That's compound interest on steroids. But here's the real magic. In year 10, Harry's yield on cost hits 7.2%. While the market still shows these ETFs yielding 2 to 4%, Harry's personal yield keeps climbing because he bought years ago and never sold. This is how wealthy families build generational wealth, not through trading, through patient ownership. The dividends Harry receives in year 10 are 122% higher than year 1. Same shares, same initial investment, but the income stream keeps expanding because these companies keep raising payments. But here's the real secret nobody discusses. Dividend stocks are defensive. When markets crash, growth stocks get obliterated. Tesla down 65% in 2022. Meta down 64%. Netflix down 51%. Meanwhile, SCHD down just 2.52% while paying 3.80%. You literally got paid to watch others panic. During the 2008 crisis, dividend payers recovered 2x faster. Why? Companies that can afford dividends have real profits, real cash flow, real businesses, not hopes and dreams. Harry learned this during the 2022 bear market. His growth stock friends lost sleep. He collected $3,200 in dividends and reinvested at lower prices. Same market crash. Completely different experience. This is why money management professionals overweight dividends during volatile periods. It's not about avoiding losses completely. It's about getting paid while you wait for recovery. Think about the psychology here. When your portfolio drops 10% but you're still collecting $3,000 in annual dividends, the loss feels less catastrophic. You have tangible proof your investments are still working. Let's talk retirement savings. Traditional advice says you need $1 million to retire. The 4% rule gives you $40,000 annually. But what if you built a dividend machine instead? $500,000 in dividend ETFs yielding 3.5% average. That's $17,500 in year 1. With 7% annual dividend growth, you hit $40,000 income in year 13. Half the capital, same income, and your principal keeps growing. Harry realized something profound. You don't need to be rich to get rich. You need assets that pay you to own them. His financial goals shifted from accumulation to cash flow. Instead of asking, "How much do I have?" he asks, "How much does it pay?" That mindset shift changes everything. A $300,000 portfolio yielding 4% generates $12,000 annually. Reinvest those dividends for 15 years at 8% total return? You're looking at $750,000 plus with $30,000 annual income. From a starting point, most people can actually achieve. This is the retirement planning math they don't teach you. Because Wall Street makes more money when you trade frequently, not when you buy and hold dividend growers for decades. So here's your blueprint for building passive income streams. Start with DGRO for growth. Perfect for younger investors building wealth. The 2.05% yield seems small, but that 10% plus dividend growth rate means your income doubles every 7 years. This is your aggressive growth engine wrapped in dividend safety. Add SCHD for balanced income, the cornerstone of any diversified investment portfolio. 3.80% yield with 13-year growth streak makes this your core holding. This is where you park the biggest chunk of your dividend allocation. Layer in DIVO for monthly cash flow, immediate gratification plus growth. That 4.52% monthly payment keeps you psychologically invested during downturns. This is your behavioral finance hack. Monthly reminders that investing works. Finish with SDY for Aristocrat protection, your insurance against chaos. When everything's on fire, you'll sleep knowing you own companies that survived 60-plus years of crises. This is your portfolio's foundation, the bedrock that never cracks. This isn't get rich quick, it's get rich surely. The strategy that survived every crash, every war, every crisis for 100 years. Because companies might stop growing, but they rarely stop paying. Harry checks his portfolio once a month now. Not to panic, not to trade, just to watch the deposits hit. And every quarter, those deposits get bigger. That's not just passive income, that's freedom compounding. One dividend at a time.